Yeah, let's go on with our ideas on business taxation, and part 5 was, as you have already seen, the corporation tax system. And now we deal a bit with the background of dividends paid to other corporations. We are still here, chapter 5, and let's first look to the problem. If shares are held by another corporation, so when we have a kind of a group, we get some specific problems. And this is easily to be explained. We have the following basic constellation. Then we have a subsidiary, so a lower company. The shares of that company are owned by a parent company. The shares of that parent company are in turn owned by natural persons. So we have 3 levels here. You can even imagine that such a constellation has more levels, so a parent, a grandparent, and then the natural shareholders, but you can see all the decisive problems already here. Now, it usually begins with that the subsidiary, so the lower company, earns money, let's say 100,000 euro. They pay corporation tax on it, let's say 20%. So what is left over is 80,000, and these 80,000 are now paid out as dividend to the parent company. So the parent company has now dividend income of 80,000. Now, if they had to pay now tax, then that would be again, let's say 20%, so 16,000. Now, what would they do with the amount which was left over? In the in the course of time, they would distribute that again to their own shareholders as dividends, so 64,000 now. And the shareholders would pay their personal income tax, let's say 25% flat rate, so 16,000. If we now look to the overall tax burden, then we have the gross profit, and then it's lowered once by corporation tax, a second time by corporation tax, and then even by income tax of the shareholders. So now we have a total of 3 taxes on top of each other. That is more than our system was prepared to deal with, because our regular idea was always we have a corporation tax and we have an income tax on the dividend, and nothing more was ever taken into account. So what can we do here? Because here you see that is a distortion where the system was not prepared to deal with. So we have to look for a special solution here. So the problem is we have 2 times the corporation tax, although our corporation tax system was only designed for having once corporation tax and once income tax on the dividends. That was then usually weighted or adjusted in a way that once corporation tax and one the dividend income tax together approximately was comparable and competitive with one-time full income tax of a sole trader. And now this second corporation tax comes on top and spoils the whole system. Everything goes into the waste bin. The system can't work anymore. We have a grave disparity in the total fiscal burden on the 2 ways how you can invest. One's corporations and a group, and the other alternative, sole traders and partnerships. So 3 times a tax burden doesn't fit into that system. So when we design a corporation tax system, you have now to react. How can we reduce that surplus burden here in a way that the overall result becomes again competitive compared with the one full income tax which a sole trader or a partner of a partnership pays? Naturally, you see, the thing which spoils the whole thing is that we have now 2 times corporation tax. So we must look for a way to reduce 2 corporation taxes to, in the total effect, only 1 corporation tax burden. And that is how our system has been conceived, we must end up with that result. This reducing of two corporate taxes to only one in the total can happen at least under two different techniques. The first one is you say we apply a kind of credit method. We tell the upper level company, so the parent company, you have to pay taxes on your dividend, but you get a tax credit for the taxes which the lower entity, so the subsidiary, has already paid on that dividend. So that leads to the following result. Your dividend revenue then consists of the dividend which you get from the subsidiary plus the amount of the tax credit granted on that dividend, because a tax credit lowers your fiscal burden, so it is as good as money. And so it's a monetary advantage, and the monetary advantage is defined as a revenue, you know. So our revenue is first the dividend amount plus the tax credit. Now, if everything has been distributed, so our revenue from the subsidiary is identical with the complete underlying original profit, 100%. This credit system would automatically probably be applied in case of a full imputation system. That would automatically be the result. So in a full imputation system, well, you remember these were systems which existed before the year of 2000 or so very frequently. Then the complete amount of corporation tax was handed back to the shareholder on the moment of distribution. So nothing happened. No risk of a double taxation or threefold taxation with corporation taxes, because every level already gave back the corporation tax, and so corporation tax was only temporary. But in the modern classical systems, shareholder relief systems, also corporation tax is definitive, and so we would have to grant such a tax credit. The other alternative is far simpler. The other alternative is just to say, okay, corporation tax has once been taken at the lower level. That's enough. So we renounce on taking corporation tax on the higher level. So you would just declare dividends tax-free in the hands of a juridical person, because a dividend always comes already from another juridical person. So corporation tax must have already been paid, and so the parent company can be left without a tax. In cases, by the way, where the tax rate on the parent company level is the same as on the subsidiaries level, this exemption solution is technically far more simple and has the same result. Good. These two solutions naturally need names, and the first one would be called the indirect tax credit method. Because here the parent company can obtain a credit for the tax payments which have already been made, but it is only an indirect tax credit. Not that the tax credit is given indirectly, but it is given for a tax which P, the parent company, has only indirectly paid or borne, because it was paid by the subsidiary, so by another person, although it has lowered the dividend income which P receives and economically relates to that profit. So that explains the name indirect tax credit method. And the other method is just called dividend exemption or participation privilege. In German, major participation is often called Schachtelbeteiligung, which is nearly not translatable. It's called Schachtelprivileg in German. Forget about this. Participation privilege will also be recognized by all couple other persons to whom you speak in Germany probably. Or just call it plain and simple a dividend exemption. Then the German solution is the dividend exemption, and you should already know that. Oh my God. And you can find that in 8b1 KSTG. You remember that important rule probably already from the general introduction to tax law lecture. Dividends which are received by a juridical person are left tax-free in the hands of that juridical person. By the way, if you then look to our original situation, you have then once corporation tax on the lower level, then medium level tax-free, and then income tax on the last level, the level of the natural persons. And so again, you have the same total tax burden as in the simple constellation where you only had a company and the shareholders, because then you have corporation tax once, then the money goes through the higher levels, and when it arrives at the natural persons, then you have the second half of the total burden, the income tax on the dividends. So everything fits now. The total tax burden in a group is now the same as the total tax burden in a simple constellation, and both are comparable to the full income tax rate, which probably a sole trader or a partnership in the partner in a partnership has to bear. So everything seems to be fine. By the way, there is an exception in 8b4. You remember that probably. That spoils the system a bit. We talk about that later. Well, so the German solution here with the dividends is rather plain and simple. It has a very good outcome. Everything seems to be fitting. The Anglo-Saxon countries prefer, at least in a cross-border context, the indirect tax credit method. In an inland case, I believe some decades ago, they also began to say, okay, we can leave a dividend tax-free in the hand of a parent company if at the lower level the same tax, the inland corporation tax, has already been paid. I believe that has sometimes been called franked investment income or so. Well, but normally they prefer the indirect tax credit. So in an inland context, this method has the same result as the dividend exemption method, so nothing to bother about. But in a cross-border context, it leads to the effect that the foreign profits of the subsidiary can only be brought back to the parent's company if you pay at least the tax level of the parent company in the final effect. That would mean the following. Imagine, just to illustrate that, because you do not yet know that, if you have a company in an Anglo-Saxon country, let's say P Limited is parent company, and it has a subsidiary in a foreign country, let's say S for subsidiary. And in the foreign country, the S Limited earns 100,000 and pays a local corporation tax of 15,000, so rather cheap. Consequently, they can distribute 85,000 then. And now P Limited has a dividend income of 85. They also get a tax credit for the underlying tax which has been paid by S. S paid 15,000 relating to that dividend income, so 15,000 are an additional monetary advantage which they can use to lower their fiscal liability at home. So 15,000 are also a revenue. So we end up with a total dividend revenue of 100,000. That is, surprise, the same amount as originally earned. Now let's compute the tax burden of P. They have 100,000 taxable revenue. And now let's assume their tax rate is 25%. Then P owes a corporation tax of 25%. They can credit the tax credit to the tax burden. That is the nature of a tax credit. You can always deduct it from your liability. 15,000 go down, so the remaining balance which has to be paid is 10,000 here. So the total tax burden on the profit is 15,000 have been paid in the country of S, 10 additional thousand have been paid in the country of P, so 25,000, so exactly 25%, the same tax rate as if the money had been earned in the country of P. If you still remember what I told you about a peculiar tax regime in England and other Anglo-Saxon countries some decades ago, that was the taxation of the worldwide income on the remittance basis. Then you see the tax system here says, okay, as long as the money stays invested in the subsidiary, the tax burden is 15,000. When you bring the money back to the country of the parent, the tax burden hops up to 25%, the tax burden in the country of the parent. That's exactly the situation which you would have in taxation of the worldwide income under a remittance basis in case of a permanent establishment. So this originally was a system which contributed to neutrality between the different forms of investment. So it was rather a good approach, but only in such a system where the credit method is so highly important and prevails. Well, yeah. So this indirect tax credit, however, can lead to some effects which are not very nice, because you can easily end up in a total chaos and suffer from complications. Because if the foreign subsidiary doesn't distribute all its profits but keep a bit of it as retained earnings, then you can end up with nice questions. S, for example, now earns 100,000 from its own country, taxable at 15%. 200,000 is earned by S in a very foreign country where they have to pay 20% on it, and 50,000 are completely tax-free under a certain privilege regime. And now S has a total gross profit of 350 and has to pay, I believe, 15,000 on the 100,000, 40,000 on the 200,000, 55,000 as a total tax burden. So they have a net income of 295,000, and S now decides to keep 200,000 as retained earnings and pay out 95,000 as a dividend to P. Now the chief accountant of P has only one nice question to solve. We can credit the tax of S, which refers to our dividend income, not the tax of S, which refers to the retained earnings. Oh my God. Now, which amount of the 95,000 net income has been taken out of the 200,000? Which amount comes from the tax-free 50,000, and which amount comes from the 15% taxed 100,000? Or do you suppose it was all mixed up and mingled, and so you have only the total profit and the mixed rate? If so, how do you determine the mixed rate? And how do you prove it to your home fiscal administration? Very, very nice ideas. So come up. Huh? The whole situation even gets a bit more interesting or challenging for the accountant's intellectual abilities if in later years the subsidiary S earns another 200,000. They are now taxed after a tax increase in the local tax area at 25%, so a rate which we never had before, and then they distribute 300,000 as dividend. Why 300,000? Well, you can distribute not only the current profit, but also you can dissolve some, or you can distribute some returned earnings. So now you pay out some old profits from old years. So the underlying tax is a tax from old years. And by the way, there you still have that problem. In the old years, when the returned earnings were kept, we had 3 different tax rates relating to different parts of these profits. So an indirect tax system is, in practice, a road to a heap of fun. Let's call it this way. So when you ever think about suicide, here are reasons. If you ever see depressed accountants, or if you ever want to turn somebody into depressions, here are possibilities. And when you ever see somebody who deals with the indirect tax credit things in a realistic case, where you have a subsidiary of the subsidiary, and the whole firms are active in 20 different countries, and then this accountant doesn't turn depressive, then you have come across a real optimist. Keep that company. Good. But you should at least understand the basic principle. So then it can become really complicated, because your fiscal administrations will not just want to know how much tax refers to which part of the dividend, but they will also require proofs, and then things get really nasty. Good. Yeah. So let's first draw or sum that up. We have 2 possibilities. You can say the dividends are tax-free in the hands of the parent company, 8B1. Or you can say they are taxable revenue, but the underlying tax is credited. Both lead to a removal of double corporation taxation. Not corporate double taxation, but an economic double taxation in a group. And so both fulfill the basic requirements that a corporation tax system can still work, even when you have groups. There is one question still left over. When we talked about dividends in the hands of natural persons, we also had to talk about the treatment of the expenses. And naturally, here also you have a problem with the expense. Very often you know that principle that if a revenue is tax-free, the revenue and the expense correlated to that should be treated alike under the same rules. So you can expect 2 different outcomes. In a system where the participation exemption is granted, where the dividend revenue is tax-free, there the temptation for the legislator is very, very high to say also the expense which relates to the participation, the expense which was spent in order to finance or make possible the dividend revenue. Also, that expense should be tax-free. And you know, in case of a tax-free expense, we don't call it tax-free, we call it non-deductible, because it cannot lower the taxable profits. Well, so this is the one alternative. The other alternative is if we have an indirect tax credit method, then the dividend is regular taxable revenue. In such a system, you have no convincing reason to ban the deduction of the corresponding expense. However, the expense can nevertheless create problems. I show you how. Imagine you have an indirect tax credit system, so you live in an Anglo-Saxon country with a traditional legislation. The profit made by S is 100,000. They pay 15,000. They can pay out a dividend of 85. You already know that example. P now has a dividend revenue of 85, the dividend, plus the tax credit for the dividend, 15,000, the underlying tax paid by S. So we end up again with 100,000. The expense borne by P in relation to the participation shall now be 60,000. Why? Well, It may be that you bought the shares in the lower subsidiary on basis of a credit. That credit costs you interest, and the interest is so expense which relates to that foreign to that dividend income. Now our income from the participation, the dividend net income, is only 40,000. Imagine we pay a high tax rate of 30%. That is now 12,000. Yeah. Now you would have expected that if the foreign tax is 15% and your home state tax is 30%, that you could completely use the foreign tax credit. That every amount of foreign tax would indirectly be received back in form of a tax credit and lowers your home state tax burden. But now there is a surprise. The home state tax burden is due to your high expenses only 12,000, so we can credit the 15,000 not in full, but only with 12,000. We arrive at zero, and we have an unused amount of tax credit of 3,000. This will get lost. You will usually not be able to carry a tax credit forward to the future, or you will not be able to transfer it to other sources of income. It will be simply lost. So that's not nice. So you see that probably here in a system of that indirect tax credit, expenses might create, in the end, depending on the constellation, economic problems. Because you end up with a far too high or with a higher tax burden than you originally expected. Well, now if you have a system like in Germany, the dividend exemption system, it is plausible that the expense will be banned from deduction, and indeed that happens. That also has negative effects, because non-deductible expense means you have to pay for that expense from tax net income. You should probably still remember how one can determine by some nice calculations how much gross income before tax you need in order to have enough net income to be able to pay a certain non-deductible expense. Well, but the problem is now, in principle, the tax exemption for the dividend revenue would demand to check all your expense categories if they contain partly or in full also some expenses which relate to dividend income. Did the secretary work some time of their working time on the dividend or on the participation? If so, that part of the monthly salary should be not deductible because it relates to tax-free revenue. It did a bit of the paper supplies, the stationery expense, was used also for letters written to subsidiaries. If so, that expense for these papers it was not deductible. And you see where that ends up. Thousands of items would have to be checked. Probably you would also have to take refuge to some rough estimates, and you would probably constantly have disputes with your tax inspection, because you would make an estimate and the tax inspector would make a different estimate, and then you would quarrel and perhaps end up in court, and all that is relatively senseless. So the German legislator, as you already know, tried to simplify life by an estimate which was fixed by the law. They say 8b, paragraph 5, in cases where you have a tax-free dividend in the game, then 5% of the dividend revenue which you received each year is always regarded as the amount of the non-deductible expense. So 100% of the revenue is tax-free. And instead now of checking all the individual expense items, you just take 5% of the dividend revenue and say, okay, we eliminate these 5% from all our deductible expense this year. The idea is, well, there might be a year when you have a zero dividend. Then 5% of zero is 5% non-deductible expense. So your real expense, your actual expense would go uncorrected. But the idea is then, okay, then you will have in the future other years where you have higher dividends. So that the 5% will be far too high in comparison to the expenses which you had in that year. So over time, the years where the 5% is too much and the years where the 5% is too low will equalize each other. So that's the idea of that 5% lump sum rule. And that simply says, okay, by this solution, we can have an easy solution which is not too unfair and saves a mass of bureaucracy and disputes. Because that estimate is meant to be correct, to deal with all the expense problems, the logical consequence is that the actual expense doesn't have to be checked. The actual expense of a participation can then always be fully deducted, even in cases where it's clearly seen and undisputable that this expense, for example, interest expense on a certain credit, is related to that participation. You can then actually deduct it because the non-deductibility has been dealt with and will be always dealt with by the estimate rule, the lump sum rule in 8b5. That is, by the way, the meaning of that rather curious sentence in 8b5 sentence 2, which says 3c2 ESDG, so expense related to tax-free revenue, cannot be deducted, that this 3c2 has then not to be applied anymore if 8b5 is applicable. Yeah, now Germany did something very strange or not nice, because for small participations, Germany abolished the dividend exemption some years ago. They declared them instead to be fully taxable in the hands of the parent company. That's a clear breach of the logic of the system, because then in that constellation you really have corporation tax, and then income tax. So 3 taxes instead of only 2 on which the system is designed. So unjust, unfair, and completely unjustifiable probably. But that's the meaning of 8b4, which says if the participation is less than 10%, then the dividend exemption is not applied, with the effect that the dividend becomes fully taxable. Then, on the other hand, naturally, the corresponding expense will become fully deductible too. That's clear. So 8b5 only if 8b1 is applied. That breach in the system was motivated by the wish to refuse a tax exemption to foreign parent companies. Under the EU rules for free movement of capital, you have to treat investors alike without any discrimination, irrespective of if they live abroad or in the inland. Now, traditionally, Germany had the nice idea to say, yeah, 8b is applicable to all juridical persons, also to the foreign one within the framework of limited tax liability. However, when you have a limited tax liability, then all the revenue which is taxed under withholding tax is dealt with under a simplified procedure. The withholding tax is declared definitive. An assessment is neither demanded nor possible, not even on application. So you do not get the withholding tax back. So in that case, although the parent company had no tax to pay under 8b on the dividend revenue, the withholding tax of 25% was declared to be a definitive prepayment which you could not get back. And so indirectly, with a trick, they took 25%, although under their own legal ideas, the parent company should pay no tax. Now, this was a clear discrimination, and however, in practice, Germany always said, we only lower this 25% definitive tax in negotiations about the double taxation treaty. There, we lower it to 15%, 10%, 5%, whatever the other state agrees upon us. And the fiscal procedure was done again, withholding taxes taken 25%. And under the double taxation treaty, you have no right to an assessment, but you have a right to apply for a partly refund of the withholding tax. So to have it lowered from 25 to 5% or so. Now, as this was a very, very clever trick to avoid equal treatment, it was clear that the European Court of Justice would just assess it as a trick and say this is naturally a hidden and unjustifiable discrimination. And to avoid this, Germany said, okay, non-discrimination will require that we treat shareholders, juridical persons, alike. Usually we grant a participation exemption only to major parent companies with a major shareholding abroad, and not to foreign investment corporations which hold a low participation. And if we want to continue that because we like the money, there is only one possibility. We also abolish the tax exemption for small participations within Germany. And that is the reason for the existence of that 8b4 KSDG. So it's a breach of the logic of the system, because it leads to a threefold, or even in more complicated groups, fourfold or fivefold levying of corporation tax. But the idea was just for political reasons. We want to keep that money. And so we want to avoid the non-discrimination principles, consequences, and we can best do this just by also treating our inland taxpayers in an unsystematic way. Then we can keep the money, because one can force us to non-discrimination, but one cannot force us under European law to establish a logical and consequence tax system. That is nowhere demanded. So to sum that up, we have, when it comes to expense in the German system, that 8b5 rule. When you have a shareholder who is a juridical person, so 8b1 dividend is exempt, 8b5, 5% of the dividend are non-deductible. And in case of a small participation, less than 10%, all that can be forgotten. Then the dividend revenue is fully taxable and the expense is fully deductible. Now, we will have to talk as the next topic about the question, how can we now design the taxation of gains when you sell a share in a way that the economic consequences are parallel and fitting to the consequences which we have when dividends are collected. And that is naturally a topic for the next video. So that shall be enough for this time. Thanks for watching and hope to see you again soon. Goodbye.